Dear students, in today's session, we will be learning about accounting for share capital. Now, before we go to the accounting part, now let us in brief discuss what is a company and the features of a company. A company is an artificial person created by law having separate entity with a perpetual succession and a common seal. So it is an artificial person created by law. So, which means just like how we individuals exist, similarly, even a company does exist. It is an artificial person which is created by law. That is, by registering, you create an artificial person, that is the company. It has a separate entity, means a separate existence from that of its owners, that is the shareholders. They have a perpetual succession, which means the company will continue to exist for n number of years until it is wound up due to certain unavoidable circumstances. The shareholders of the company may keep changing, but the company will continue to exist. And the company has a common seal, just like how we individuals have a signature. Likewise, even the company, since it is an artificial person, they have a common seal which acts as the signature of the company. Now, coming to the characteristics or features of a company. Incorporation. The company is incorporated or registered under the Companies Act. It has a separate legal entity, which means a company has an entity independent from that of its members. That is, the shareholders are different and the company is different. The company has a name for itself, okay? And the common seal of the company acts as the signature of the company. A company is an artificial person created by law. Since it is an artificial person, the company can own property in its own name, that is, in the name of the company. They can enter into a contract, conduct business, sue or be sued for its debts and actions. So, a company has rights to purchase property in its own name, sell property, enter into an agreement in the name of the company. Perpetual existence. A company has a perpetual succession, which means the company will continue to exist unless and until it is wound up due to certain unavoidable circumstances. The shareholders of the company may keep changing, but the company will continue to exist. The next, liability, limited liability of the shareholders or the members. So, which means in case the company's liabilities are more than their assets, and if they are unable to repay the liabilities, in such a case, the shareholder will only lose the amount invested by him in the shares. He need not, bring in his personal property to repay the liabilities or loans of the company. So the liability of the members or the shareholders is limited only to the extent of the share capital or shares that he has purchased in the company. He will lose his share capital, but he need not attach his private property to repay the loans or liabilities of the company. So that is why we say the liability of the members, that is the shareholders, is limited. Now, what is the difference between a partnership firm and a company? A partnership firm need not be registered. It is not compulsory to register a partnership firm. But the partnership firms are registered due to convenience sake as per the rules laid down by the Indian Partnership Act of 1932. And that is, in case of a company, registration is mandatory. That is, the joint stock company should and must be registered as per the Companies Act. Now, the liability of the partners is unlimited liability of the members is limited to the amount of shares held by them. Now, in case of partnership firm, business is managed by the partners. But in case of a company, since there are many shareholders, the business is managed by the elected representative of the shareholders called the board of directors. And in case of a partnership firm, the death, retirement of or insolvency of the partners may affect the continuity of the firm. But in case of a company, death, insolvency of the shareholders will not affect the continuity of the company. Now, coming to the types of companies, there are two types of companies, that is, a private company and a public company. Now, let me tell you in brief what is a private company and what is a public company. A private company is a small joint stock company where the shares of the company is held by a group of people who are generally friends or relatives. But in case of a public company, it is a very large joint stock company where the shares are subscribed by the common people, the general public. In case of a private company, the shares are not easily transferable. But in case of a public company, the shares are generally transferable from one shareholder to another shareholder. Coming to the share capital, the amount that the company receives towards share capital from the issue of shares. So, this share capital, we can classify it, which means we can have different phases of share capital. Now, what are these different phases of share capital? Now, first one is the authorized capital. So, in your previous, that is in your first PUC, previous year, you've already learned what is the procedure to be followed at the time of registration of a company, okay, and what are the important documents that the promoters need to prepare at the time of registration of a company. So, in that, one important document that the promoters need to prepare is the Memorandum of Association. And this Memorandum of Association, contains a clause called the capital clause. So, which means now if the capital clause mentions the capital of the company is going to be rupees 5 lakhs, which means the company can raise maximum capital to the extent of rupees 5 lakhs only throughout the life of the company. They cannot issue shares for more than rupees 5 lakhs. The shares should be issued only to the extent of rupees 5 lakhs. Now, this authorized capital is nothing but the capital mentioned by the company in the capital clause. So, it can also be called as the nominal capital or the registered capital. This is the capital mentioned in the Memorandum of Association in the capital clause, and it is the maximum amount of capital which the company can raise by issuing shares to the general public. Now, let me continue with the same example. Now, the authorized capital is rupees 5 lakhs. And now let us assume that this 5 lakhs is, divided into 50,000 shares of rupees 10 each. So, this 10 rupees, we call it as the face value of the share. Each share is rupees 10, and this 10 rupees is called as face value of the share. Now, 50,000 shares of rupees 10 each will give you 5 lakhs. Now, initially, the company may not issue the entire 50,000 shares to the public. They may issue the, let us say, 30 or 40,000 shares, how much ever required. They will issue the remaining shares as and when required. So, out of 50,000 shares, now let us say the company issues 40,000 shares. So, this 40,000 shares, okay, into 10 the face value. So, rupees 4 lakhs becomes the issued capital. And then next, after you're issuing these 40,000 shares to the public will now start subscribing to the shares issued by the company, which means they will start applying for the shares. They will start applying, that is, they will start buying the prospectus and fill in the application and submit it to the company because they want to buy the shares of the company. Now, out of these 40,000 shares, sometimes they may be able to sell all the 40,000 shares. If the company is a reputed, I mean, if the company is doing a very good business, if the nature of business is really good, the shareholders may be impressed and the entire 40,000 shares will be sold out. Sometimes the public will subscribe or apply for only, let us say, 38 or 39,000 shares. Okay, so the minimum subscription should be at least 90%, which means out of this 40,000 shares, okay, the public should have subscribed at least for 36,000 shares. 90% of your 40,000 will be 36,000 shares minimum they should be able to sell. They can sell, if they are able to sell entire 40,000 shares, well and good. Okay, so this 40,000 shares, if it is fully applied for by the public, then we call the entire 40,000 shares as the subscribed capital. Suppose the general public has applied only for 38,000 shares, then 38,000 into 10, 3,80,000 becomes the subscribed capital. But at no point of time it should be less than 90% of the issued capital. In this case, the example I'm giving you, it should not be less than 36,000. If the subscribed capital is less than 36,000, the company cannot go ahead with the further proceedings. Okay. Now, this stage, let us say the entire 40,000 shares, the company has, they have able to sell shares for the entire 40,000, they are able to sell. Now, each share is worth rupees 10. That is, the face value of each share is rupees 10. Now, the company may not require entire 10 rupees from the shareholders at once. So 40,000 into 10 is 4 lakhs. So they're just starting the business. They are in the initial stages. Okay. They're just starting the business. They are in the initial stages. So what happens here is they are in the initial stages. So they want to receive only, let us say, 4 or 5 rupees from the shareholders. They don't want the entire amount at once. So they will ask the shareholders to pay only 4 rupees out of 10 rupees. The remaining they will ask them to pay later when there is a requirement. So this 4 rupees which they have asked the shareholders to pay out of their 10 rupees. So 4 rupees into 40,000 will be how much? That is your 1,60,000. That will be called as the called up capital, which means out of 10 rupees face value, the company has asked the shareholders to pay only 4 rupees per share on 40,000 shares. So, which means the called up capital will be 1,60,000. Now, when the company asks the shareholders to pay, some of the shareholders may not pay the amount due when it is called by the company. Out of 40,000 shares who have applied for, let us say only 30,000 shareholders have paid 4 rupees. The remaining 10,000 shareholders have not paid 4 rupees. Okay, so 10,000 into 4 is what the company has not received. They have received 30,000 into 4. So 1,20,000 is what the company has received. So this part of the capital which is received by the company is called as paid up capital. Okay, so I quickly summarize the whole thing. Authorized capital is the capital mentioned in the capital clause. That part of the authorized capital issued to the public is called as issued capital. That part of the capital where the public has applied for is called as subscribed capital. That part of the capital which the company has asked the shareholders to pay is called as the called up capital, and that part of the capital which the shareholders have paid is called as paid up capital. Okay, so with this, I complete my first session, and in the next session, we will go with the types of shares and the procedure to be followed at the time of issuing the shares. Okay, thank you.